Are you looking to start investing in the Kenyan stock market? We have just the solution for you. Introducing Dosika, a mobile app that is designed to make the Kenyan capital markets accessible to everyone with a simple to use interface. The app provides real-time updates on stock prices and news, which is crucial for investors. Here's how to sign up. Download and install the Dosika app from the Google Play Store. Create a Dosika account by signing up with your email address and phone number. Once you've signed in and linked your account, you are all set to start adding securities to your watch list or portfolio. To track the performance of your portfolio, go to the Portfolio tab and view your holdings. Dosika ni investment chap mkononi. Dosika, grow your wealth.
Yeah, I think we have more than quorum, so we can get started. Thank you everyone for making time, and it's actually encouraging that all of you are actually waiting in the lobby. That all of you, most of you are actually waiting in the lobby by the time we were starting, so it's very encouraging. For those who don't know who we are as an entity, the Central Deposit and Settlement Corporation is a private limited company with shareholding including the Nairobi Securities Exchange and other players like issuers and whatnot. And our main role is to provide settlement, clearing, depository, clearing, and settlement services. What that means in layman's terms is when you buy or when you want to hold shares or when you want to transact in the equities market, that is the Nairobi Securities Exchange, you need to have a CDS account where those shares will be held. The same way that if you wanted to transact in any currency, you would need a bank account. So we facilitate the deposit of those shares, and then when you buy or sell those securities, we are also the guys who are in charge of making that transfer or that settlement possible. Now we've been doing this for 20 years, so we have some good experience in handling that, and we have ever since CDSC was established or started operations in 2004, we are proud to say that we quote unquote may have eliminated those challenges or those fraudulent transactions that were led to some brokers' demise in the early 2000s. So our business is trust and is to ensure that the market is stable, and we do that by facilitating efficient and secure, efficient, and transparent deposit and settlement services. So if you want to know more about us, you can visit our website on www.cdsckenya.com or follow us on our social media platforms. We shall be soon joining TikTok at CDSC Kenya. And for purposes of introduction, my name is Steven Atema. I work in the, let's say, the marketing strategy and research function in the organization, and I'm very happy that one of our partners, we call them Central Depository Agents, but you guys call them stockbrokers, who is Standard Investment Bank, one of the best in the market, is here today with us through Wesley to share with us some insights about how the global situation or the global events, including things like what people have been talking about, the Tesla and Safaricom situation, how they affect or would potentially affect your exposure, or would potentially pose an exposure risk for your investment in the different counters. But I'll not speak for Wesley. I think him and his team know more about what they do than I can explain. So I'll just like to welcome Wesley, who will be our main speaker for today. So for purposes of you to understand our flow, we shall have Wesley sharing what he has in store for us, especially helping us understand how our globalized economies, interrelate, and what that means for our local portfolio. But also then we can have a session with him later after the presentation, and including you guys to just try to get your questions answered and some of the things that maybe you might need more clarity on. So without further ado, welcome Wesley. You can do your intro and segue into your presentation. Thank you.
Thank you, Steve, for having me. You can see my screen?
Yes.
Thank you. Hi, my name is Wesley Manambo. I'm Standard Investment Bank, a senior associate with the research department. coverage running through non-listed stocks in the Nairobi Securities Exchange. As a team, we have coverage that spans from sustainable finance, looking at the banking sector, and the macroeconomical environment with the fixed income in the Kenyan market. Just to give a story of our engagement today, which is titled Investing Locally in a Global Economy. It is known that as time goes by, we've become a global village. And they say when the big brother sneezes, everyone catches a cold. Others who are more philosophical will try and say there is something called the butterfly effect, which means a small event in one place causes a very big turbulence in another. And with the global community growing intertwined as time has gone by, we've had a lot of opportunities opening up and a lot of risks coming up as a result. To give a bit of who we are as Standard Investment Bank, we are the largest investment bank by headcount, with around 150 employees. We've been around for over 30 years, about 30 years now, with one of our products, which is the corporate finance, the deal and advisory team, closing projects with transaction worth over 200 billion. In terms of our products, we offer research and sustainability finance coverage. We offer stock brokerage. That's where me and Steve come into play with regards to equity investments. We also offer Sharia compliant investment banking solutions, fixed income, that's your bond trading, buying and selling, trading, getting into the market and out, and also global markets through our flagship product, Monster X, which has given investors exposure into global assets, including alternative assets, currencies, metals, commodities, global equities, and the like. Not to take much, we look at this, and I'd try to hit the trifecta by looking at a small understanding of how markets are classified, what to look out for, where we stand, and then look into 2024, what has stood out, what quarter four holds into play, and then tie it all together to the Kenyan stock market context. Globally, markets are classified into three. That's the developed markets, emerging markets, and frontier markets. A lot of the classification is based on the economical development, and I'll try focus this presentation towards markets specifically. Developed markets are known to be very efficient markets. They're awash with liquidity, which means they're favored in terms of capital. You'll be shocked to see how strong the regulatory framework is because of that capital base. Again, they tend to deploy advanced technologies, capabilities in their markets, and most of the investors in that base tend to be sophisticated, which in turn leads to efficient in terms of asset pricing. And how this comes into play is because of the ability to go long and short. If prices are misrepresented in the market based on present, past, and expectation of future information, the short sellers will try take advantage of it. Long sellers will try take advantage of it. Now, removing that aspect of arbitrage, what we call that aspect of getting free lunches. So in effect, that makes their pricing quite effective. Some of these markets include the US, Germany, and Japan, just to name but a few. And below the developed markets, we have the second class, which is the emerging markets. Some say emerging markets have the traits of developed markets, but fall short in a few criteria, including the fact that they are transitioning most of the time from low to high income status, and their markets tend to be quite integrated with the developed markets. Again, because of the opportunities in these markets, you'd find there's a lot of foreign investments in terms of foreign direct inflows and foreign portfolios inside their stock markets. Again, this in turn leads to the fact that for investors who are quite keen on specific asset classes, they can take advantage of the thin investment coverage as opposed to the developed markets to really lock in some profitability. So in essence, emerging markets offer higher potential for growth compared to developed markets, but then that comes with an aspect of risk. Below emerging markets, we have frontier markets, which in essence tend to be very young markets, very small markets. They tend to have very limited capital, quite strains in ease of entry and exit, quite inefficient in terms of pricing. And that inefficiency in pricing really brings about a lot of opportunities in terms of getting undervalued assets and really growing them as they get into their journey of price discovery. Some of the markets include Kenya. We sit within the frontier market space. Based on the classification and the argument that an economist would like to push, some will classify frontier markets as a subset of the emerging markets. Now, without taking much time, really go deeper into the equity markets. Globally, we sit at an estimated real global market capitalization of about $98 trillion, give or take a bit. And this slide shows the division of capitalization across all markets, developed markets, emerging markets, and we curated the data that we had from Goldman Sachs, the global research powerhouse, to incorporate the changes within the frontier markets, which in some sense is a subset of the emerging markets. It will be quite interesting to note that as expectation is by 2025, developed markets will account for close to about 68% of total market capitalization, with emerging markets falling at about half, and frontier markets in totality account for quite a minute stake of 1.62%. When we try dig deeper into where Kenya we sit at around global market capitalization of about 0.0137.8, give or take a bit. Looking at this market capitalization, we note that most growth over time will be driven by emerging markets, meaning capital will be likely shifting from the developed markets toward the emerging market. Asia will be a key beneficiary. India, most notably, will grow from an estimated of 3% in 2025 all the way to about 12% in 2027, with China really remaining key, holding its spot at about 14%, give or take a bit. And this is majorly driven by the heavy demographic base in these countries, because people are a ready market. I mean, if you are selling a product, you have a ready market within the people. And the demographic outlook, the demographic dividends in Asia are quite attractive for this. In the markets, we say correlation does not mean causality. And to really put this into perspective in market capitalization, we do not expect to see a direct, or rather, growth in market capitalization does not mean growth in performance. But then the economists who did this analysis, bulk of this analysis in Goldman Sachs, estimated that in as much as this does not necessarily hold all the time, emerging market equities are expected to perform developed markets in the long run, and this will be driven largely by the good earnings outlook that they'll be having, the better valuation metrics they'll be holding, and the falling of their risk, the overall risk outlook. Worth noting is the fact that for emerging markets really, and even frontier markets, to unlock these potential that they're sitting on, they noted that there will be need for the policymakers to adopt capital market friendly policies that encourage innovation, transparency, encourage to see more listings, because it's through more IPOs that you'll see the market cap growing, and also protecting the private property rights and also encouraging ease of entry and exit, among other factors. In our curation of this data that we picked from Goldman Sachs, we estimate that by the 2027 mark, developed markets will fall in terms of global market capitalization to about 44%, 43.43%. And within the class, there will be a lot of shifts. I mean, shifts from the US to Canada and the likes. And as attention of capital shift towards the emerging markets, this will also see a gradual rise in in the market capitalization to about 55%, with frontier markets really holding their grounds minutely at about 1.7%. The most important takeaway from this slide will be to know that frontier market is it's at the lower end of the global equity market capitalization waterfall. That means for an investor who, with global exposure, they really have keen interest in global equity market asset classes, likely with investments in the US, then maybe look into emerging markets as a second option, maybe India, China, and then what's left, then they would see these investments falling into frontier markets. And again, when risks globally, when global risks rise, we'd see a reversal of these flows from frontier markets to emerging markets and to the developed markets, because in the market, we believe that capital is very shy and it will always revert back towards stable markets that offer the lowest possible risk, because the assumption is that investors are risk averse. What that means is they'd want to avoid risk as much as possible, but also they're driven by the potential for return. So in developed markets, you find risk are quite low, but then the possibility of stable returns are quite high. Now, looking at opportunity cost, now going a little bit deeper into
Wesley,
this.
Hi, as you continue, there is a concern that by the audience that maybe your language is a bit too technical for the audiences. So they're asking that maybe you tone down on the jargon and try to, what is it called? Try to talk to both the technical guys, but also the just the normal investor. Thanks.
That's well noted. Now, looking into the opportunity cost, now put yourself in the shoes of an investor sitting with the ability to invest in developed markets, emerging markets, and frontier markets. When risks arises, and this will be in a macroeconomical environment when we see central banks rising their policy benchmark rates, what we call the interest rates, when they rise, you'll find them shifting their capital from stock holding into the fixed income securities, because now they're offering more in terms of yields and also coupon for new issuance. And again, the risk of default, in as much as it's increasing, the risk metrics are lower than in equities. So you'd find there's that shift when interest rates rise from equities, your stock holdings, to fixed income. Again, you'd find them moving from the more riskier markets, frontier markets, into emerging markets and into developed markets. So the shift moves away from the riskier markets. You try to avoid risk and to go where risk is small. That means investments will move from equities to bonds, capital movement from equity to bonds, movement from frontier and emerging markets where we see it into developed markets, the likes of the US. And again, trying to avoid technicality, interest rates affect how companies are valued, really, in what we call the discounting factor. That means how you estimate the present worthiness of future cash flows. And it means when interest rates are high, it punishes valuations because you will be discounting harshly. So it means your equity valuations, your stocks will be valued at a very low price, but then that does not necessarily reflect the underlying value of it. And again, it also pictures the start of easy money, because now your fixed incomes are offering more than the riskier securities. You're getting more returns from the less riskier securities than the riskier securities, as it should be. So we call that the easy money, start of the easy money. But then where we stand right now and where we project would be going, holding all factors constant, is that globally and even locally, interest rates should be falling. Now that means investors likely will be flying back into riskier assets because number one, valuation metrics are better, outlook is better. Again, the less riskier assets are offering less with regards to their returns as opposed to risky assets. Now you're coming back to that metric where the more risk you take, the more likely your returns will be. And that's now where we are likely going into. And now with that understanding in mind, we'd like to see what 2024 has been so far and what we expect for the latter part of the year. Looking into 2024, at the start of the year, we believe that investors should take caution with the markets, what our friends in law will call caveat emptor. I think it's Latin for investors be heed or take caution or be informed, something of that sort. So we believe that investors should step into the 2024 investment landscape aware of the risks that were coming, because 2024 was a very interesting year when we're looking at it in the start of the year, because there were persistent risks that we were coming in through 2023. There were the likelihood of new uncertainties that we would face in 2024. And then there were very interesting opportunities, what we would term uncommon opportunities. Unlike any other period, we will not find it in the global landscape. Looking at the persistent headwinds that we had, the persistent risk that we were facing coming into 2024, first we had the global tensions. I mean, we look more into the next slide, but then we had the crisis in Eastern Europe coming in, and most people will ask, how does that affect me? I'd give you a very interesting statistics. When the Middle East crisis escalated, I think it was in 8th October 2023, into the close of the fourth quarter of 2023 and into the first quarter of 2024, there was a lot of reroute of seabound cargo around the southern tip of Africa from the Red Sea. An interesting statistic will point that sea transport accounts for almost 80% of total global cargo transportation, with 15% of that going through the Red Sea. Now, with a reroute around the southern tip of Africa, it meant that the goods will take longer time to reach you sitting here in Kenya. It means the freight costs will have been higher. It means backlogs will have been more. So the cost that you'd have faced without that single reroute, it means that the cost of the goods you'd be importing would have been much, much higher. Some of our friends sitting in logistics would even point to the fact that cargo freight charges have gone off the roof. And also, I mean, insurance, if you're insuring those cargo with elevated risk, it goes up, it goes really, really high. And that now affects how that good will be priced into you. And then that also trickles into inflation, because inflation looks at how good prices are priced in year on year. I mean, if a good was priced at 100% this year, last year March, and this year March it's priced at 103%, that's a 3% year-on-year rise. Now that 3% will mark inflation rise. Now that will affect inflation. Inflation will affect how your central bank will look at its interest rates and how they allow banks to lend into the larger economy in a bid to control pricing. So living in that global village, really far away factors come to affect you. Now that's speaking into the geopolitical tension. We were coming from an environment, rather transitioning into 2024 with global economies fighting inflation amidst very high interest rates that the central banks had set. There were fears of economic slowdowns, credit risks, fears were rising up the risk. Looking even into the US, there were questions about the sustainability of the debt, of its fiscal debt. And again, cybercrime has remained a very, very key risk. 2024 had new uncertainties because we are walking into a year we didn't know how these risks will have remained. I mean, look at Russia-Ukraine. It's a conflict that started in 2014, further escalated in 2022, still ongoing almost 2.5 years after its escalation in 2022. It's still a persistent risk. So escalation of major conflicts was a key risk. Again, global polarization and fragmented political and policy landscape was another key risk, knowing that almost 60 countries are going into election in 2024. AI has remained a very big topic, and its use case in both business, in the business world and the military, has remained a key concern because AI is geographically concentrated. You'll find China and America, in terms of geographies, have a lot of the development. And again, going around its regulation, how far do we regulate? How far should we not regulate? Has remained a key issue because you don't know how much. If you regulate, maybe the unregulated market, AI development will shift towards that market. I think I was reading through Financial Times earlier this year, and I saw someone from the European Union was talking about the need for Europe not to over-regulate AI because it will shift this AI technology advancement into the American market. And again, there were a lot of uncommon opportunities globally. Most in the developed markets, equities were rallying. I mean, gold has remained the darling of the year. Fixed income, there was a lot of fuss about private credit from late last year, walking into 2024. Long-term bonds, they were offering very, very good valuation, even as the unwinding started on the shorter end of the yield curve. That means the bonds that have shorter duration. And with the conflict that we've been seeing, that with the escalation of the Middle East conflict, oil now has had a sense of price discovery, which has provided investors with an opportunity to lock in some returns on that. Now, looking at what central banks have been doing through the year, what's really stood out, one has to be China. Shortly after the US Fed announced their 50 basis point rate cut, the 0.5% rate cut on their policy rate, China came up with a very interesting stimulus package. They were offering 0.5% cut on the average interest rate. They were lowering the bank reserve requirement, meaning banks would be in a position to lend more into the economy. And they came with a very interesting offer of injecting 130 billion to support its stock market. Now, from a global perspective, what this means is a lot of investments that are coming out of developed markets likely will be skewed towards the Chinese market because there's a lot of support. Looking through CNBC early into the week, fund manager in the US was saying, buy everything China. It's not a good advice, but then it pointed to the fact that this stimulus package is making this market attractive for investors who are unwinding the position in the developed markets. US remains key. They cut their Federal Reserve rate by 0.5%, in line with about 65% of what the market was expecting. Some would argue it was not the wisest move, me included, but that's a conversation for another day. Expectation in the market is that they still cut to the latter end of the year in the November and December meetings by a total of about 50 basis points. The impact of this into global market, it means all the money that was reverted when they started hiking their rates into their fixed income will start coming back into emerging markets and favoring equity positions, both in their markets, emerging markets, and likely frontier markets. Japan is another interesting market. It's on another end altogether. It started its hiking in June, trying to curb the slide of the yen against the dollar. Its impact has to be with carry trades, and that's when investors borrow money at low interest rate, go invest elsewhere, make returns, then profit on the margins. Looking into 2024, geopolitics, I mean, World Economic Forum through a survey done by Invesco reported that geopolitical concerns have overridden inflation concerns as a primary risk factor in the year and into the fourth quarter of the year. 60% of the nation, as mentioned earlier, were going to the polls. The US election is coming up in November, a very, very key and decisive moment for the markets on how capital will be shifted, the decade-long Russia-Ukraine crisis going. We've seen Middle East crisis, even escalating with what's happening between Israel and Iran. And China-Taiwan, what many people tend to really put in the side mirrors, remain a potential flashpoint because I think in the 75th Communist Party meeting, the Chinese president really talked strongly about the reunification of China and Taiwan when the time comes. And we think that will really affect movement of capital between the two markets and policies too. Global polarization is another key concern. I mean, the world is growing apart by different reasons, politically, trade related. There are very many reasons that are drawing us apart than closer. And that is a very key risk because it will affect how businesses operate globally and also how capital moves through the markets. The other main risk into 2024 is climate change. There was an interesting report done by the National Bureau of Economic Research when they pointed a 1% rise in the overall global temperature is linked to about 12% decline in global GDP. And again, with climate change comes sustainability, investing comes ESG reporting standards. And you find companies that are not aligning with this, they are at a risk in terms of their going concern and their operations running into the long term. In a nutshell, all this tying it together from a global perspective, what does this mean into 2024? Fed rate cuts are expected in November and December meetings. We expect to see the USD likely to remain flat against what's happening in the Middle East, and oil actually rallying and profiting, and investors who are taking a long position from that, they will be able to recoup some losses. Again, gold should remain a darling, and cash and near cash securities that are your T-bills, they should start seeing lower return as interest rates go down. And now investors will likely be shifting their capital from developed markets into emerging and the frontier markets. Now, bringing it home into the Kenyan context, what does this mean for us sitting in Kenya? When you look at the performance of the NSE from 2019, let me pick 2020 for ease of explanation. Globally, we had COVID. 2021, we are reverting back to the new normal. 2022, we had the Russian-Ukraine cataclysmic shakeup into the whole core inflation and outlook of the global dynamics. That was 2023. 2024, we were stepping into 2024 with majority of what was happening in 2023 with additional escalation with what was happening into the Middle East. That was the global situation. But again, they say sometimes when there is no additional bad news is good news. You look at the NSE returns, which are dollarized in dollar terms, meaning you have adjusted it for Kenya shilling movement against the dollar. In 2021, when you're adjusting to the new normal, it was up by 9.4%. Then came the 2022 crisis. It dipped about 23%, which was largely affected by the depreciation of the shilling against the dollar in that period of time. But then knowing that we are sitting in a frontier market, a market that is about 65% in terms of trade volume controlled by foreign investors, it means sometimes the pricing might be disattached to the fundamental value of companies. And to put this to perspective, you look at in 2024, 2022, and 23 and 24, the foreign investor participation into our market was going down from about 56% all the way to where it stands right now to about 45%, recovering from the last year average of 40%. So we are seeing them coming back into the market. In terms of their trades direction, when we look at what they bought against what they sold, if you buy more than what you sell, we call that a net inflow. If you sell more than what you bought, we call that a net outflow, because majority of the money went outside. So looking at it from that perspective, from 2021, they have been selling, getting out of our markets. We've seen capital being repatriated into the emerging and developed markets. This means it pushed valuation, it pushed pricing down, because pricing at the end of the day is as a demand of supply and demand. When supply is too much than demand, prices fall. When demand is higher than supply, prices go up. So with them selling and them being accounting for almost 65% of the market, you expected to see prices averaging downwards over the period of time. Good news is, as we stand in today, as of the close of the market yesterday, I was not able to adjust my pricing for what happened today because of the timing effect. The oil share index was up 39.9% in dollar terms, partly driven by the 19.7% impact by the shilling gaining grounds to the dollar. Again, foreigners have turned positive, buying on a net perspective about $1 million. Now, milestones that have happened in our market over this period of time, we've seen global indices really giving Kenya a vote of confidence. It started with the FTSE Russell Index reclassifying the Nairobi Securities Exchange from restricted to pass, which means investors who are keen on following this index sitting in London, US, would likely now invest back into the Kenyan market. MSCI followed suit, which is another. MSCI is the Morgan Stanley Composite Index by the Morgan Stanley Global Powerhouse. They again gave us a vote of confidence in May when they really stopped their special treatment, or rather pointed to an end of the special treatment into our market, with reports of better liquidity into the market, and also the ability of foreign investors to repatriate their capital, with the dollar shortage, quote unquote, really easing into the year. Again, they went further and added 2 stocks into their index, frontier market index, that's Bank and KCB, and they added 5 other counters into their frontier market index, BAT, Kengen, Kenya Re, and DTB. What this means is, for foreign investors who are sitting out there, they want to invest into this market, they have more options for them to come into this market. Now, going into the fourth quarter, our outlook is that most stocks in key sectors, through the banking, telecommunication, a bit of energy, they have remained strong in terms of their fundamental operations, the ability to really go into the future as a going concern and remain profitable. They have remained stable. The thing has been that valuation with higher interest rates has been punishing them from a valuation standpoint. And now, as interest rates are going down, we expect to see better valuation, and investors externally and even internally, your fund managers picking these stocks up and riding on that bull run. Technically, there are 2 metrics from a technical price perspective. There's something that we call mean reversion. It means what it says. Mean meaning going back to the average, reversion reverting back, or rather going back. So mean reversion says, in the long run, prices go back to the average mean when there's nothing interesting or shocking happening into the market. And the average mean is quite elevated than where prices are. So it means that prices will likely go upwards from this point in time. And from this point, we believe investors who position themselves in getting into the stock market right now, into value peaks, will be able to unlock returns when these foreign investors come back into the market on better valuations externally, trying to get the first move advantage, so to speak, before all others come in. There are those who will try to come back in fast. So we'll see the market reverting back upwards, because at the end of the day, as I mentioned earlier, prices is as a function of demand and supply. Our top picks are Safaricom, KCB, and Stanchart. The 2 banks have remained fundamentally sound. KCB's move to get rid of the National Bank of Kenya, we believe it's something that will help its capitalization, and also maybe release some cash in the form of dividends with the close of the deal. Again, there was a strong recovery with KCB Bank Kenya, and they reverted into paying dividends this year with an interim dividend. Stanchart has remained a very strong bank, with digitization expected to boost its non-funded income. That's earnings that are not coming from loans and investment in government securities, and also retain its cost-to-income metrics, which the lower it is, the better normally. Safaricom, it remains a very, very fundamentally sound company. I know many people have jitters about what's happening with Sterling, but then it will be interesting to realize that Safaricom's fixed, it's operating 2 businesses, what we call the financial services, where you have your M-Pesa, the asset management product Mali, and then the GSM. GSM is an acronym for the telecommunication business. In the telecommunication business, they sell data, they sell your voice revenues, when you message, use USSP, and also fixed internet connectivity, your fiber. Now, satellite internet is coming in as a competition to fiber internet, which is about, I think, give or take about 15 billion into their 300 plus top line revenue. So it's a very small business margin. The key risks, however, remain if Starlink goes for what we call D2D connectivity, direct to device. That's when you can go for satellite connectivity right into your mobile phone. Now that remains a key risk. But then I've covered this company for about 3 years, been in touch with management on the earnings call as far back as 2023. The 2023 financials, that's about the calendar year 2022. They were talking about test of satellite connectivity. So this is not something that has caught them off guard entirely. It's just that it has caught them off time. And they already did operational tests. What was left is finding an economical case for its implementation, which we believe they have right now. And just looking into some key interesting economical numbers that we've gotten this week, Kenya's GDP numbers came in at, for the second quarter, came in at about 4.6%, which was a slower growth compared to 5.6% in a similar quarter last year. Agriculture, real estate, financial services, all were on strong growth. Mining and quarrying and construction were the two lagging indicators with the GDP. What this means is, on a year-on-year perspective, we are growing. The economy is growing from last quarter where we were and this quarter where we are. The economy has grown slightly slower. From last year, benching it to the previous year, it was 5.6. Right now, it grew on a year-on-year perspective, 4.6. Still a growth, but a slower growth compared to the other period. And inflation numbers came out. People asking 3.6% inflation, that's really good. Yes, it is, because it sets a stage for the Central Bank Monetary Policy Committee to really unwind their policy decision. I know they are to meet next week on Tuesday, that should be 8th October. And again, it brings some sort of confidence in terms of the effectiveness of the monetary agent, which in most markets tend to be in question. The only worry with inflation remains core inflation, which is inflation when you remove food and fuel, because they tend to be very erratic. When you remove those two, inflation has remained generally flat, what we call sticky, which really puts into question, it really points out to a general rise in the overall cost of living and doing business within the country. Finally, the purchasing managers index, which is the outlook of manufacturers and producers in the economy, is that stability. Normally, this rate goes by the 50% mark. Above 50 is a positive outlook. Below 50 is a negative outlook. Looking into the numbers that we got in, I believe today, the September 2024 Purchasers Managers Index was at 4.9 from 50.6 points in August, which means there is a slight expectation of deterioration in the private sector business activity. And with that, I think, and for the sake of time, I should hand it back to you, Steve, for questions.
Wow, that was a very, I'd say technical, but very insightful. If you're keen, I think you might have picked one or two things. And this is why for me, I prefer talking to experts when it comes to investments. And I say that because if you are watching if you're on social media or watching the news in the last for the last 3 or 4 weeks, you would imagine that Safaricom was going to go under because of Elon Musk's Starlink. But even as we were speaking, I was trying to look at the financial statement for the previous year, and I was looking, and they were saying it's around the data is around 17 or around 18% of their service revenue, which is still not low, but considering in terms of all their revenue, it contributes to less than 10%. It's quite telling that sometimes we might overblow some news, and it's good to always, whenever you're in doubt, please always reach out to your financial advisor. In this case, if you're an investor, you would have to reach out to your stockbroker and ask them, this news about Starlink, what does it mean for my investment in Safaricom? And if you've been watching the counter of the Safaricom counter, I don't think it even moved in that period. So it tells you that maybe the people with money are not too keen on this what do you call them, these headlines, which are sometimes too over sensationalized. And in any case, if that were to happen, from my understanding of how Safaricom operates, most of their business is catered to the lower cadres of society. So Starlink is a very niche product, if you ask me. And if you're looking at its potential disruption, it's probably what Wesley had talked about, where probably Starlink ends up doing more than just internet. But as it stands right now, it is still quite a long way from bringing a threat to Safaricom. But be that as it may, you should always exercise caution when you're dealing with investment. Now I'll start with you. You said something that today I've had two main catchphrases, which is no additional bad news is no additional bad news is no additional bad news is good news. And I was thinking, but Kenya seems to be continuously getting bad news, bad news or bad news. So are we in a bad state? But that is on the lower side, on the softer side. Now to serious questions, eh? Part of your presentation has focused on the inflation and the geopolitical risks and of course the interest rate conversation. And you said in one of your statements that the world seems to be growing apart. So for Kenyan businesses, and I assume some of our investors are businesses, or some of the investments that they are in have international exposure. Is that a good or bad thing? Because one would argue that this is, there are two sides to this. There are people who would be happy if the world continued to be growing apart, and there are people who would be saying no, because of the way their businesses are interconnected globally, then they would want that status quo to remain. I don't know what you can briefly just comment on that, because I see several questions already on the chat.
On that, I think the world growing apart is really a concern, because number one, you'd want the world growing closer because now you're accessing other markets. Look at Safaricom, for instance. It's now into Ethiopia. It's no longer a Kenyan business. Almost all Tier 1 banks in Kenya are regional businesses, domestically significantly important banks. That's what we call them. Listed in Kenya, operating in Kenya with subsidiaries outside Kenya. So you'd find movements in DRC will affect, negative movements in DRC will affect business outlook. So the world growing closer, it opens up into new markets. It opens up the flow of capital, easy flow of capital. And unless you're selling military equipment, I don't think you'd want to see the world growing apart. So unless into that business, maybe that will be your prayer point. But then for the rest of us, we want it growing closer than apart.
That's good. That's a very good, and I like the way you've just summarized it. That for any business, that most of the counters that most of us, even from your 3 stock recommendations, all of these businesses, I think apart from Stanchart, SAF and KCB are regional businesses right now, or are Safaricom at least wants to be a regional business. And when the world is growing apart, then it is definitely going to have a serious impact on their ambitions. And even you in your if you are working as an organization that has global ambitions, every time that it faces hurdles, then that also likely affects the potential of that business to grow, and possibly even your future income. So I'll be switching between my questions and the questions of the audience, so that we have a balance. And there are some very interesting questions that I would like you to also address quickly. There's a question by Anne who is asking, when you say that these prices are going to revert to normal, what year should they be benchmarking with, so that they know when I'm looking at my counter, let's say you've told me to buy Safaricom, what is my price target? In fact, I would just say, for purposes of illustration, maybe for the 2 KCB, Safaricom and Stanchart, you could give maybe the target pricing based on now that discussion about reverting to the mean.
I'd love to focus on Safaricom, being a telecommunication analyst, and normally it's ill-advised to benchmark price based on past performance, because even our disclaimers say past performance is not an indication of future performance. So I'd not advise you look at price as an indication of where it was, but then look at it against valuation estimate. Because one of the main reasons I have a job at an investment bank is to try to look at the end of the day, what's the intrinsic value of a company? For Safaricom, our estimate is at about 33 shillings per share. That means when investors come back in, the prices will likely revert towards its fundamental value. For Safaricom, fundamental value is about 32 shillings, its price is about 15 shillings. Now that is an upward swing. Because it's not always about past performance, because you'd find maybe in this 2-year period when there has been a lot of noise in the global environment, there are companies that have become worse fundamentally, and there are companies that have become better fundamentally. So looking at the fundamental value and the fair value estimate is a good indication of where the prices will be moving.
Okay, so you're saying look at fundamental and just based on the Safaricom pricing, definitely you would call it an undervalued counter at the moment.
Absolutely. Yeah.
Yeah, and I think, and if you want more detailed insights, Wesley would share their group email for the research team so that they can give you better advice and hopefully move you to their side. Martin is asking how frequently we have these sessions. Usually we have monthly webinars. So if you follow us, again, like I said, follow us at cdsckenya.com, you will see the information about when the webinars are held. We usually have it with different webinars, not always Wesley. So if you want to talk to Wesley regularly, maybe he can share their contact details, but we have different stockbrokers that we deal with. People are really interested in Safaricom. I guess it's understandable considering how big the counter is. It's the biggest counter on our exchange. But I don't know if you want to comment on this. What are your sentiments about Safaricom's engagement with Chief? And what impact would it have on the stock?
Well, there is a sentimental, or rather, there is an investor outlook. They hear news and it prices it into the stock. As an analyst, I'm not that interested in that outlook. I'm interested in what that impacts into their financial numbers. What will that mean into their revenue? As opposed to, is it good, is it bad? I want to see it in the numbers. Now, without seeing that the financial numbers, I really have no opinion.
Yeah, that's true, and it goes back to there's this view where people say whether you love a brand or you hate it, as long as you're transacting with them, you're not really hurting them. So even if you love or hate Safaricom, or whether you have opinions about Chief, as long as Chief is as long as that activity is bringing business to Safaricom as an investor, then you have to practice being agnostic about sensational news, so that when something is happening that does not directly affect the fundamentals of a company, then try to shun it and ignore it. Another question that I had before I go to the question on for the people still asking on Safaricom whether it's undervalued, then I think we have already answered that. There's this thing you talked about, the all share index, the NSE all share index, benefiting from those global shifts, as you're going back, you're talking about how money moved back into the developed markets because the European market and the US market were increasing the rates. But then now, in the last few months, the Nairobi Securities all share, the NSE all share index has done 40% dollar returns. I wanted you to just help the audience understand, what do you mean by the all share index doing 40%? What does it mean when you say the all share index is up 40%?
Looking at its movement from where it started the year at and where it is right now. I believe it was at 1992, give or take a bit, and where it closed the market yesterday. It was about a 16% movement, give or take a bit. But then where the dollar was, the exchange rate of the shilling against the dollar at the start of the year and where it is right now, then combine those two metrics, you're looking at it for an investor. Because, if you look at it as at local currency terms, and our market is about 65% foreign trading, you'd find investors who are looking at it from a global line metric, and dollar is the global currency for trade.
Yeah.
That into the global metrics, it shows you now what everyone externally is looking at the Kenyan market at. And number one, that speaks to, it's partly driven by the stability of the Kenya shilling. I mean, I've been looking at foreign exchange rates across bureaus in town for the last 8 weeks, and it has remained stable at around 129, 128 shilling. So there's a lot of stability, and that was even before the US started cutting their rates. So before and after that heavy US rate cut, there was stability in the exchange. In the exchange, now you expect investors looking externally to just come in, because those who are timing the lowest possible exchange rate to get the most out of that investment now are unwinding that mindset to get into the market at the current pricing. And again, foreign investors from year to date, they have net of what they bought and what they sold, it's a positive of about $1 million. Now it shows that the direction of when they were selling, they're starting to come back into the market. And the most important thing is to remember pricing is as a factor of demand and supply. When the supply is too much, demand is low, prices go down. Like what we've seen
Yeah,
in the
that's
last
true.
week, them selling off. But now we are seeing a rise in demand, and now the supply likely will be meeting the demand, and now demand outweighing supply, and now we see a reversion of prices now heading towards where the fundamental value or the fair value estimate or the target price is at.
True, true. But I guess also that question is about why is an index an important metric to look at? And maybe you can speak about what the NSE what is the NSE, so that when you're even giving us the I think it was the MSCI index, people can fully appreciate why it is important to read and worry or be happy when an index is 40% up. Like, I think just for purposes of our investors who are mostly interested in the local space, why is the NSE an important metric?
In a market, there are those who buy, there are those who sell, there are those who get hurt, and there are those who profit. Now, look at it in terms of stocks. Today we had top gainers, today we had top losers. Net net, the all share index, it looks at all those stocks and their movements by the day. When it goes up, it means majority of the stocks with the highest, majority of the stocks from a market cap perspective, they gain. When it loses, it shows majority of the stocks from a market cap perspective, they lost. So an all share index, rather, or a benchmark index, it shows you a bird's eye view of how the market is performing. Now, when we say the all share index is gaining year to date to about 39% in USD terms, it means across all the 60 plus listed stocks, most of them have had a price discovery.
I think that is
price discovery.
Yeah, I think that explains it. So that whoever is wondering why you keep mentioning the indices understands that you could not if you are looking at if you are an investor now trying to look at whether you should invest in the stock market, then if you just if you just had if you were just to get a glimpse of whether the market is performing or it's in a bearish trend, then looking at the all share index would be a good way to start, and clearly it has been a good year for most of the counters. A question here about why is Kengen, again still on the indices, why is Kengen, Kenyari and DTB added to the MSI list? Were they? Maybe you can answer that.
Added to their frontier market. They pointed towards adding them to their frontier small cap market, and it's for the index contractors who are Morgan Stanley. When they looked at the market and looked at the performance and outlook of these stocks, they saw them as being very attractive picks that of the Kenyan market. So it really points at what I mentioned earlier as a vote of confidence, because now most stocks are being seen as stable with a good growth outlook. I mean, look at Kengen, for instance, it's a very good stock for an ESG sensitive investor. It's almost 100% green, good carbon credits that they are pocketing in by the investment. So you find when you consider all those ESG metrics, look at their performance, look at their outlook, look at the stability strategy, they saw them for whatever reason they might be to add them. They saw it fit to add them into their coverage. The key take home should be when more stocks are added, it's a positive sign. When stocks are removed, then it is a bad. It is it's not a good sign for an external watcher into that market.
Makes sense. And I guess the bottom line is when the more counters are added, the better it is in terms of the investor perception about your market. There's an interesting question here that I don't know if we want to get into right now, but there was a question about how do you calculate the intrinsic value of those different counters. Maybe even as you touch on that, I would like you to also answer a question by, I think he's called Papa. He's saying that how can one utilize bearish trends for capital gains? Because you said as investors, most of the time we tend to look at the positive side of the market, and even as we tell investors to be, looking at the to be value investors, you're looking at a counter going up. But how can one also utilize the bearish trends to make gains?
Okay, you've asked two interesting questions, one fundamental, one technical. Starting with the fundamental, intrinsic, you have to go into the annual reports, look into the company's strategy, go look into the company's market share, its competitors, how is it performing, how has it been performing. And I think we did a video late last year with Steve on the same, and it's quite detailed. Maybe if you go through their social media platforms, you might get a wind of it. But then technically, intrinsic valuation of fundamental value is found by looking at the ability of a company to generate cash. Because at the end of the day, it's all about money. Can it sustain its operation? Can it pay you as an investor? Will it need more money from you? Now, intrinsic valuation is looking into that. Then once you're done with looking into the historical performance, you perform some sort of forecasting. Once you're done with forecasting, you get the cash flows. Then through through a technique of discounting cash flows, you get what we call discounting factor. Now, interest rates, now that's the conversation about interest rates really punishing valuation metrics, because when they rise, it means you'll be discounting harshly. Most of the most common discounting factor is what we call weighted average cost of capital, which you're looking at what is the average cost of equity, what is the share of equity of the company, what is the share of debt, what is the cost of debt. It sounds very technical, but that's why we exist. So the easiest way to get an intrinsic value is just get in touch with your brokerage house or your stockbroker, investment bank, and they will give you that value for you. We do that.
I think that is the best
investing
advice.
easier for you. Our job is to make investing easier for you and provide you with all this information at first-hand basis. Secondly, looking at how to profit from bearish trends. Sadly, short selling is not in our market. When you go into the developed markets with more advanced technology, with more sophisticated investors, you'd go short on an investment, meaning you bet on it, go. But then in the Kenyan markets, we are still a very young stock market, not that much of sophisticated investors in the market. I think even derivative, it has not picked that much, and even day trading itself has not picked that much. So it needs some level of sophistication. But then, be it as it may, without all that level of sophistication or being in a position to short a stock, an investor who bets that the price of a stock will go down would sell that stock, wait for the prices to go a little bit downward, then buy it back again. They profit in the sense that they either get more stock holding for the same amount of money, or release some capital and get the same number of stakeholding. So say, or for argument's sake, you bought a stock is trading at 10 shillings and you have 100 stocks. You expect it to go down by your own estimation. I mean, you are seeing this is a bearish trend. This stock will go downward. It goes down to 80. You sold at 100, you buy back at 80. It means you've released, for the same shareholding, you've released around 20,000, give or take a bit. Now that becomes your profit because you have the same shareholding, but then you have unlocked capital of some sort. The other outlook would be now you have more shares for the same capital of 100,000. So those are the two metrics on how you can take advantage of bearish trends. And the best thing is to look at get in touch with your stockbroker. What's the outlook? Do they see this stock going down? Then, based on your own estimate, should I sell? If you see fit that you're getting into a bearish trend, get rid of that stock. Then wait for it to price to go a little bit lower. Now you can imagine someone who sold Safaricom when it was at the highs of 45, then picked it back at 14 shillings. For the same amount of shares that he had at 45, he has unlocked a lot of capital. Or rather, if he reinvested all that money back into the stock, now he has way more shareholding. Now that's how you can profit from a bear trend in the Kenyan stock.
Thanks. That's very good, and that's very detailed. I see people asking questions about specific counters. I would urge you to reach out to Wesley. You can type your research email so that you can give the specific. Whoever wants to reach out to you for specific counter recommendations, they can reach out to you. And even the website where you usually post your research documents for guys to just go and internalize those documents. But again, like we always say, if your day job is not investing in the market, please try to utilize your stockbroker, because most of them have research analysts and senior research analysts and a whole team to just every day look at the market to help you make sense everything. I don't know if firstly if you have any closing remarks, so that in the interest of time, we had so many questions, but maybe we might do another video just you and me to answer some of the questions that I had picked from your presentation and those that I also had, and then we can share it with the audience. But I don't know if maybe you have any closing thoughts and any other additional statements to the investor before I comment on the people asking for presentation and recording.
Okay, I think I don't have that much, but maybe an advice for potential investors and those who are really looking to get into the market. There are 5 golden rules that I always go by that I believe are very key for every investor to look at. The first rule is always focus to trade well, not just get into the market for the sake of making profits, because in the rush for making profits, you might make very expensive mistakes. 2, fiercely protect your capital. The third is act immediately without hesitation on qualified steps. The only thing worse than being wrong is staying wrong. That's the 4th rule. And the 5th and the most important rule is, if you're ever confused, remember rule number 2, which is, again, the best quote from one of the best money managers, Peter Lynch. He said, don't just buy cheap stocks because they're cheap. Buy them because the fundamentals are improving. Stocks do well for a reason and they do poorly for a reason. Make sure you know why that. Make sure you know what that reason is. And stocks are not lottery tickets. There are companies behind every stock. If a company does well, the stock does well. In short, always endeavor to know what a company does, how the stock has performed, get some information before just buying. And to make it easier for you and remove the guesswork out of investing, I believe that's how in part, investment banks and stock brokerage houses exist. So get in touch with the broker house, and they will help you remove that guesswork out of investing.
Thank you very much. Well put, Wesley. I'll just answer one question, which I think you might agree with me there. When you talked about the NSE or the Nairobi All Share Index, there was a question that, one counter has moved more than 800%. Would that affect the NSE? It would only affect the NSE if that counter had a big market capitalization. But the counter being mentioned here has a very small market cap, so it would not affect NSE. And chances are a counter that has a big market cap would not move 800% without people noticing or even action being taken on that counter. So those are speculative counters that usually have those wild swings. But thank you very much, Wesley, and thank you for our audience. Again, if you wanted to know or you want to know more about CDSC and what we do and when we shall be having our next webinar, please follow us on our social media platforms. If you're on Facebook, LinkedIn, Instagram, Twitter, or X, and very soon we shall also be joining TikTok at CDSC Kenya. You can also follow Wesley via his LinkedIn profile. He does a lot of analysis and shares that very insightful text on that. I think, Wesley, you can post also the research. I don't know if you had shared that, the research team's email for people to seek advice and also know how to be part of the SIB family by being investors or clients, and also where they can get the research reports that you guys publish on a monthly basis. And I was delighted to know that actually the monthly report for September is already out. So if you are interested in knowing what happened in the market in September, you can go to the SIB website. For those who want the presentation and the video and the video recording, please, if you are part of this session, trust me, we shall get the recording. We usually share the recording after a bit of editing with our guests, as well as the presentation, if Wesley will be kind enough to share with us. But if not, we shall also communicate the same. Otherwise, thank you very much. Have a good evening, good morning, and good night. Remember to always be mindful about your investment. Stay safe, and see you in the next one. Bye.
Bye-bye.